Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, so this week, Mena and I would like to talk about our favourite time of the year, which is end of financial year tax planning. It's something that we really look forward to more than Christmas or summer holidays, of course. So we wanted to talk about, what are some of the things you might want to think about leading into the end of the 23-24 financial year. And when undertaking some tax planning, the first thing that you need to do is really sit down and work out what do you think your tax position will be this year. Now, whether you do that or if you've got a trading business and so forth, you might get your holistic accountant to help with that. But essentially, you want to know, how much taxable income you have this year and how important is tax planning. You also want to give some consideration to what your income might be next year as well, as much as you can try and forecast that. Now, you might know that you're planning on divesting of some certain assets next financial year, for example. So you might know you've got a capital gain in that year and you want to sort of take that into account, knowing that maybe you're better off to defer deductions to next year rather than bring them into this year. But the starting point has to be, what sort of tax liability you're facing. Where are you compared to the tax brackets? Have you just crept into the next tax bracket? In which case then, if you can find some deductions and bring yourself back down into that lower bracket, you're going to save some tax. Or in fact, maybe if you're well and truly past the top marginal tax bracket, from an income perspective, then there's not really, you want to maximize your deductions, of course, but maybe there's not a whole lot you can do with respect to minimizing tax.
So the first one that we commonly sort of advise clients is about super. We typically, obviously if cash flow allows it and depending on your taxable income, we typically advise our clients to maximize their superannuation cap. And obviously there's other factors to consider here, such as what debt levels you're carrying, what's your income going to be in future years. Are you going to have, for example, a CGT event in the preceding year where we would sort of want to use that contribution for the following year to maximize its tax effect. But generally what we sort of advise clients is to maximize the superannuation cap, because obviously if you're at the top marginal rate, you're sort of saving 47 cents on the dollar there.
The other thing to think about too is if your income is $250,000 or more, you're probably going to be liable for what's called Div 293 tax, which essentially means your concessional super contributions attract another 15% in terms of tax. So when you make contributions into super, whether it's your personal contributions or contributions on your behalf made by your employer, they're automatically taxed at 15% already throughout the year. After you've lodged your tax return, if your adjusted taxable income is $250,000 or more, then you'll get an additional bill for what they call Div 293 tax. Now, if you are just on the cusp of that 250, you might want to think about whether there's any deductions you can obtain to bring yourself below that 250 amount.
Also consider your unused concessional contribution caps. So if your superannuation balance is below $500,000 as at 1 July, then you can carry forward contribution caps that you haven't utilised in prior years. Now, this has been a rolling rule since 2018-19 financial year. So that means that the 2018-19 financial year is the last opportunity, I should say, where you could actually utilise the cap from the 2018-19 financial year. So really encourage you to sort of look at, whether you're eligible for this and whether your cash flow is sort of healthy enough to utilise that year's carry forward.
And similarly, because this carry forward opportunity only exists if your balance is less than $500,000 at the beginning of the financial year, well, if your balance has exceeded that $500 balance during this financial year, then obviously, unless the share market absolutely dies in June, your balance on 1 July 2024 is likely then to be above $500,000. If that's the case, then this financial year is the last time you'll ever be able to use the carry forward opportunity. So if that's the case, as I said, it was below 500 beginning of the financial year, now it's higher than. Make sure you go and find out, how much carry forward that you have available, unused caps from previous 5 years, and then consider making all those contributions this year. It's most likely going to be really tax effective, and as I said, it's your last opportunity to do that.
And don't use your concessional cap this year if your income's going to be high next year. So things to consider is, for example, if you've got a property sale coming up or a business sale where you're going to realise a large capital gain, then you might be better off, that is if you're not close to the $500,000 limit that we spoke about, to defer the contribution till the following financial year to get a better tax outcome.
If your spouse has a low income, there's a couple of things you can do super-wise with them as well. The first one is you could make a spousal contribution into their super. So if you contribute $3,000 into your spouse's super, you will then receive, if their income is less than $37,000 this year, you will then receive a $540 tax offset. That's not a deduction, that's an offset, which means it reduces your tax. The second thing is the government co-contribution. So if your spouse's income is less than $43,000 this year and you make, or they make, a $1,000 contribution, non-concessional contribution into their super, the government will not match that contribution but also contribute $500. So that's a pretty good return, and there's only a few things that the government do to give away money, so it's not going to change your life but worth pursuing.
The next thing is to consider is the stage 3 tax cuts. So as it's well sort of publicised, there's going to be some sort of favourable tax changes to the individual tax rate. So if your income is between the $180,000 to $190,000 mark, then you might benefit from, or you would actually benefit from, bringing forward tax deductions this year, as you'll receive a 47% deduction on those deductions rather than a 39% saving.
If you want to reduce your income tax this year, everyone wants to do it, but, of course, but, if the goal is to really focus on this year as opposed to shifting deductions next year, then you want to think about all the deductions you can bring forward into this year. So, if you're looking at paying for financial advice or taxation advice or any advice that would be tax deductible, maybe you can bring forward that expense before 30 June. If you've got investment properties that you're planning to do some repairs to, try and get them done and pay for them before 30 June. And the only other thing that is a major expense that you can potentially bring forward is paying interest in advance. So it's a different style loan product which allows you to pay next 12 months of interest in advance so that you can claim the interest in this year, although the interest rates aren't that attractive at this point. So unless your income is going to be substantially lower next year, probably not really worthwhile.
Also, if you've got income in a trust environment, you might want to consider, if all your beneficiaries are sort of capped already that $180,000 mark, which equates to about a 30% average tax rate, you might want to retain some profits or make the trustee accessible as such, those profits within that trust. Now, that means that trustee will pay 45% in tax, whereas if you actually have to pay those profits out at a beneficiary level, you'll be paying 47%, which includes the Medicare levy. So there's a 2% saving there by doing so.
And if you're a self-employed business owner, there might be a whole host of other additional business-related tax planning measures that you can implement. So it'd be silly to try and list them all here because it's going to really depend on your personal circumstances, your business structure and the type of business that you're in. But of course, that's something you should have a chat to your holistic accountant about.
And lastly, just consider what administrative matters you need to complete before 30 June. So obviously all your distribution resolutions if you've got a trust arrangement. So basically you need to declare who you want to distribute to before 30 June. Consider completing any sort of family trust elections or interposed entity elections if necessary as well. So something to speak to your holistic accountant about. And finally, also your notice of intent to claim tax deduction forms for your superannuation contributions. Unfortunately, we see a lot of people disorganised and not prepare those in time, but although they don't need to be completed until before your lodgement due date of your tax return, we generally advise clients that it's good practice to do it at the same time that you do superannuation contributions, so at least it's a set and forget.
So there you go. There's a few things that you can think about this year. We tend to think tax planning should be done twice per annum. So really at the beginning of the financial year and towards the end, because if you only do it once a year as in towards the end, there might not be a lot you can change now over the preceding sort of 10 months. So if as a process of going through this tax planning measure, you identify these areas to optimise, well then maybe you can sort of build a to-do list for yourself for the next financial year so that in a year's time, you can put in place measures to minimise tax. Okay, that's it from us for this week. Until next week, bye for now.